One of the biggest drivers in the market, if you didn't know, is interest rates. And it's to do with global liquidity. If interest rates drop, then money comes into the system, comes into the stock market. And the trend in interest rates is one of the biggest drivers for stock markets. And if there's a change in attitude towards interest rates, it can turn a stock market. So what we're seeing at the moment is a bit of a sell-off thanks to concerns about an AI bubble. But we've got the US market starting to bottom again, and the expectation is that interest rates are going to come down. Just 3 weeks ago, after the last Fed meeting, we saw Jerome Powell tell us that a rate cut in December is by no means guaranteed, no way. And the odds of a rate cut in December in the US dropped from 100% down to 30%. It's now back up over 80%. And there are a few things driving that. There has been a lot of Fed speak, which is Fed governors talking. There's been a lot of Fed speak in the last week about rate cuts. We know Stephen Moran, who is a Trump stooge on the Fed board, wants a 50 basis point rate cut. And now suddenly we have a White House official being favored as the next Fed chair taking over from Powell next year. Scott Bessent, who's obviously a Trump-aligned official, is interviewing people for Powell's job at the moment, and he's interviewing someone called Hassett, who is very much in the Trump camp. And the feeling is Trump is going to say something before Christmas about who the next Fed governor is, and it could be Hassett. And he has already talked about 50 basis point cut in December. So suddenly we're going to have, I know everyone's got upset about Fed independence and how terrible it would be if the Fed got touched by Trump. But let me just tell you, the way the market's seeing it at the moment is it's probably a good thing. The most obvious thing is if Trump gets his people onto the Fed board, then interest rates are more likely to come down quickly, which the market likes and might actually be appropriate, inflation aside. But the other thing that I think we all have to think about is does the Fed need a shakeup? Yes, it does. Just go back and have a look why the GFC happened. It happened because, as Greenspan admitted, in the 2000s, they kept interest rates too low for too long, created a housing bubble, which turned into a mortgage-backed security crisis, turned into the global financial crisis. They then printed money and by their own admission, didn't tighten up fast enough. And that money they were handing it out to large investment banks in the US who were putting it into the markets. They were supposed to make it available to the economy, to refloat the economy. Instead, they were buying with this cheap money from the Fed. They were buying asset classes that were going up in price and making billions out of printed money. And the Fed didn't tighten up fast enough. That created another bubble. Then in COVID, they've gone and printed money again. And in COVID, inflation picked up and they called it transitory. So interest rates were sitting at 1% for far too long again. And suddenly they woke up in January 2022 to realize inflation wasn't transitory and interest rates had to go from 1% to 5% in the US, which doesn't really matter in the US because 90% of mortgages are on fixed rates based on the 30-year mortgage, 30-year bond yield. So if you can raise rates in the US, it doesn't affect consumer spending, but it's the other way around here. We're all on variable mortgages, or anyone with a mortgage is on a variable mortgage. You put rates up here and the consumer gets affected. So for the Fed mistake, if you're worrying about Fed independence, let me just point out, if you know somebody who took out $1 million mortgage in the year 2000 and thought that interest rates were going to stay at 1% because the Fed was telling them that, they quintupled and everybody got nailed because the Fed got it wrong. So let me just make it clear. If you have struggled because interest rates went up in the last 4 or 5 years because the Fed got it wrong, it's the Fed's fault. It affected you. It didn't affect US consumers. So Australians have been nailed by the Fed as well. So point being, the Fed is not the messiah. It's actually been a rather pathetically run, badly managed institution. And If the price is it has to get touched by Trump, let it get touched by Trump because it needs a bit of a sort out. So the bottom line to all this is I think the market will like the Fed being touched by Trump because it'll mean lower rates and it won't dump because of the Fed independence worries, which were around 6 months ago. So let's see who's appointed before Christmas. If it's a Trump appointment, add that to Stephen Moran. If he is also reappointed next year, we're going to see lower interest rates in the US, and that's probably a good thing. And if the Fed gets shaken up, that's probably a good thing too. Hi, I'm Marcus at Marcus Today. We've got two options for you. The first option is to do what everyone's been doing for 27 years at Marcus Today, the self-directed investors looking after their own investments using all the information, education in the newsletter, and sometimes copying our income or growth portfolio or strategy portfolio or Henry's small caps. We have another option now, which is the Marcus Today strategy portfolio, which is a real fund. It's been running since February. At this point, it's got over $60 million in it. It's growing very rapidly. We have a target 20, which is a rather ambitious target to get a 20% return per annum. And you now have the option to invest in that. So that should provide high transparency investment option, which suits pretty much everyone.